Chapter 11. And this is all about how to evaluate a project and how to know what relevant cash flows are. And it's a wonderful chapter that explains how to put together all of the information you need to manage a project and to forecast whether it's going to work or not. This is what I would say maybe the most important chapter in this particular semester because of the knowledge, the background knowledge, and the decision-making knowledge it gives you. So this is what we're going to look at throughout this particular video. We're going to look at the guidelines by which to measure cash flows. We're going to explain a project's benefits and its costs, and how its cash flows are calculated. And we're going to look at options of being flexible, options or flexibility in budgeting. And then we'll kind of look at the measure of risk. That's a lot to pull into one chapter, but we'll see how far we get. I may have to cut this into two sections, but let's see what we come up with. So first we're going to look at why do we need guidelines, and guidelines help just guide us and give us consistency in this project. You're going to look at it to evaluate investment proposals, so you need to be able to measure the value of each proposal, and then we have to really sit down and say, okay, what is or what isn't a relevant cash flow? And these are your guidelines. There are about 10 of them, and they fairly well lay out what you should and shouldn't do when you're looking at all this data. So let's kind of go down through them. You should use free cash flows and not accounting profits. Now, what does that mean? When you look at that, what the heck does that mean? Well, it basically means that there's a big difference between an accounting profit and cash flow, or true money. Remember when we did the cash flow statement and how we used it to reconcile the net income to the cash account? That's a bit like what you're going to do in a evaluation of a project. And that's simply because accounting profits don't reflect the actual money in hand, and that's what we're looking for in this case. So we need to look at the money. And so that kind of tells you use free cash flows, not accounting profits, and then we need to think incrementally. And as you think about that, you need to look at after tax, okay? And they must be measured incrementally, meaning each year, okay? We just can't say, oh, this is a 5-year project and I'm going to get $500 million from it over the length of the project. That won't work. You need to look at it, what you're going to get for each year. Each time you get an additional cash flow, and you need to look at that throughout the project, just not at the end of the project. So that's kind of a new way of looking at keeping track of expenses, because we're used to accounting, and accounting doesn't quite look at the cash flow versus income. So the next one is beware of cash flows diverted from existing products. Okay, so that means, okay, number one, not all incremental free cash flows are relevant. They may be counteracted by other outlays, okay? So if you have a new product that achieves cost at the losing sales of an existing product line, even though it's a cash flow, it kind of detracts. It does detract from the overall cash flow of the company. So you have to realize and really analyze what are the cash flows and what are the effects of this cash flow. The next one was look for incidental or synergistic, isn't that a beautiful word, effects. And what that's saying is they may take sales away from a current project, but they also may bring in other new cash flow energies. And that's what they call the synergistic effect. When I'm trying to think of a really good example. When Apple sold their iPod and created it and brought it out, that also increased their sales in phones, it increased their sales in computers, it increased their sales in other products that Apple made simply because the name was out there and it was so popular. And the iPod was so easy to use that people just decided to take a look at the other items that Apple had for sale. So it's really important to look at, okay, if I do this, how is it going to affect something else? Is there an outflow from it, or is there an inflow from it? Is it going to increase our customers' awareness, or is it going to create problems? So next we have work in working capital requirements. Now usually, if you look at this, working capital is going to be affected one way or the other. I don't see any way around it. You're either going to have to increase your inventory, okay, and that's going to affect working capital. You may increase your accounts receivable. You may increase accounts payable. However that's looked at, you need to realize the difference between what working capital was and what it is today. Is that an increase in flow or a decrease in flow for cash? So you have to kind of really watch the effects of what you're doing, especially in the inventory part. Now, what's kind of interesting is, especially if it's in the inventory area, when the project terminates, that working capital is usually recovered if there's a decrease, because you're going to sell all that inventory. So it all balances in the end, but you still have to pull it out so it's separate. Then the next one is consider incremental expenses. Not only do you want to consider free cash flows incrementally, you want to look at the expenses that are that way also. And that would be something like this. If you have to train new staff, okay, you have training expenses. If you have to re-engineer a production facility, those are expenses. Those are outflows. So those have got to be taken into consideration and countered against the cash flow that increases the net income. So be aware of that, and that should be in an after-tax state that you look at it. Then we look at sunk costs. They're not incremental costs, okay? Sunk costs have already happened. They would have happened whether we do the project or not. So they really cannot be considered as a outflow or an inflow. If we've already spent the money, then it's not really attached to an inflow or outflow. So you need to ask, will this cash flow occur if the project is accepted? Will this cash flow occur if the project is rejected? And if you answer yes to number 1 and no to number 2, then it's an incremental cash flow. Now, if you answer yes to number 2, then it's not. It's a sunk cost. It's already been there. So it should not be included. And then we have opportunity costs. So what would you do with this money? We have to consider this. Well, how would this money that you're going to invest in this project be used if it were not on this project? What are we passing up? How about using building space for the project? Will mean a loss of potential rental revenue. So you have to kind of look and say, okay, yes, I could do this project, but what else could I do? That's called an opportunity cost. So you have to think about that. You then have to decide if overhead costs are truly incremental cash flows. And what are they saying about that? Not all overhead costs may be relevant. Utility bills may be the same with or without the project. So you have to, again, you go back to that question. Would cash happen with this project? Would cash outflow happen without this project? So, if you answer yes, no, then, and it's an overhead cost, then that shouldn't be considered as a relevant cost or as a relevant cash flow. And finally, you need to ignore interest payments and financing flows. And why is that? That's because when you do the evaluation, you're going to take interest cost into effect. So you want to stay away from interest. So when you're evaluating these cash flows and you're bringing them back to present value, trying to decide if the project is feasible, you are using cash in that discount rate. So the required rate of return implicitly accounts for the cost of raising funds to finance that project. So that's the guidelines of how to decide if a fund or if a cash flow is relevant or not. Now I'm going to end this, and then we'll pick up on the 4 steps you should take to create a project evaluation. So hang in there.